Good afternoon, everyone. This is Michael Browne, head of commodities at Barchart. And once again, I'm joined by Darin Newsom, the president of Darin Newsom Analysis. Thank you all again. We're going to be covering the grain markets again today. Darin's going to give an update on what's going on there. And when Darin is finished, we'll go through a couple of new things that we've done again recently on Commodity View and some of the new analytical tools that are available both in the Commodity View product and in the accompanying Excel add-in. While we go through this, there is a question panel in your dashboard. Feel free to submit questions and we'll get to those at the end of the two presentations. And with that, I am going to turn it over to Darin Newsom. Darin.
Thank you, Michael. And as always, I appreciate you having me on again for this third in a series of 3 summer market and update webinars. And as Michael said, I appreciate everybody joining us here today. It's going to be a lot to talk about. And again, I do hope if you have any questions at all for me or for Michael, please send them in. There'll be plenty of time at the end to get to the questions. And you know, we're just at that time of year where we are coming to the end of the 2019-20 marketing year and looking ahead to 2020-21. August is often a key month for both corn and soybeans, and that's what I'm going to be focusing on today is corn and soybeans. It's a key month, so I know that there's a lot of questions out there. Markets have been doing some crazy things. So if you have questions about markets other than corn and soybeans, Michael and I were having a great discussion before we came on, you know, about some of these outside markets. One that we didn't touch on was, I mean, silver is just incredible right now, gold and silver. So there's a lot going on in the marketplace. There's a lot to be considered. There's a lot to talk about with agriculture, because again, we're in August, and August are the dog days of summer. It's hot. As I said, we're coming up at the end of one marketing year, looking towards the beginning of another. It's usually a critical point in time for the development of both corn and soybeans, even though I know it's usually viewed more for soybeans, and particularly this year with the crop supposedly or reportedly running ahead of schedule as far as progress goes. But, you know, weather is the key. Always has been the key for the summer months. And it just seems like right now weather's been pushed. I don't know, maybe the spotlight's not even on the weather at this point. The biggest thing is right now in both markets is we are just talking about huge crops. That's really all it is. And I know Michael's going to touch on this in his part of it. So the dog days of summer. Here's what normally happens in the month of August. The red line is the 5-year index that I've built, and I know the Barchart system has a different has a different seasonal tool, seasonal study. This is just the one that I've built over the decades and the one I've stuck with. I certainly use Barchart data to build mine, but this is what my seasonals look like. And this was as of the, you know, so the green line is the 2020 December corn contract. Red line is the 5-year study, a 5-year index study based on an index rather than prices. And the blue line is the 10-year. And so at the end of August, as you can see, is when we usually hit the seasonal low on the 5-year index on the red line. And the 10-year tends to post its low at the, you know, in September-ish. Late September usually. So at the very least, if we follow these seasonal patterns, that would suggest that the 2020 contract just breaking to a new low. We hit 320 earlier this week. It would suggest we have more room, more time, I should say, to go down. And given something that I like to call the round number reliance, where corn tends to move from round number to round number, if we were to break that 320 that we hit earlier this week, that would suggest down to 310. And if I use this seasonal index, the 5-year seasonal index, to calculate a potential low weekly close, and these are all based on weekly closes, these indexes that I have, it would suggest a low of about 304. So, August is set up seasonally to be another bearish month for the December corn contract. Where's the selling going to come from? The non-commercial side, and again, I know Barchart has all this information. You can pull it every week off the CFTC reports of your choosing. I like to look at the legacy futures only, the simplest report that they have, the very basic numbers. And what I'm looking at is the non-commercial net futures position, which is the blue line that I'm showing here. And basically it just takes their long futures and subtracts off the short futures. And that gives me the net. And what we've seen here over much of the summer, June and July so far, is they have been covering some of their short position that grew to almost 250,000 contracts through early June. Now, the problem is, will the non-commercial side, and when I say non-commercial side, I'm talking about spec funds, I'm talking about algorithms, I'm talking about all of the investment, just the investment side of the market in general. Will it decide to start rebuilding that net short position, possibly pushing it back to the 250,000 contract, if not more level? Because here recently we've seen it cut to about 100,000 contracts. We didn't see much of a rally off of all that, but we have seen some short covering. So will the non-commercial side actually start putting pressure on this market again? And if so, will that be enough to drive the Dec Corn contract below 320, down towards 310, possibly below 310 and towards $3? It's a possibility. But here's where things get interesting. I also like to look at distribution. And again, these are based on weekly closes only. And if we look at the 320, where the Dec Corn was, and we compare it to its weekly closes, in this case, going back through 2014, and I'm doing it back to there because that starts almost immediately after the 3-year drought that we had between 2009, I think it was between 2010 and 12, with 13 being kind of the transition year as far as the Dec contract goes. So going back to the 2014 contract, and we look at the weekly closes and we look at that 320 mark, that was as low. We were at the low. We were at the lowest weekly close over the last 6 or 7 years, over the 6 or 7 contracts going back to 2014. Usually when I look at this, when I look at a chart like this and we get all the way over to the left-hand side, that usually means a contract or market can be considered oversold, undervalued, and it starts to actually, the theory behind it is it will start to actually attract buying interest. Will it this year? Because again, what we're talking about is a market that just now seasonally going into a time frame when more selling tends to occur, when we get more comfortable with the crop size. And I know there's going to be there should be a number of questions about crop size when we get to the end of this. So if we are going to actually see a crop that continues to get larger, how is this 320 going to hold? What would keep the non-commercial side from continuing to sell, from rebuilding that net short futures position? This is the threat that we have. Yes, by price distribution, by this chart, by looking at this range, we should be near the low. We are at the lowest marks that we've seen going back to 2014. Would that alone be enough to get buyers to come back into the market? I don't think it will. I think the market's going to have some help. I think Dec Corn is going to have to find a different reason for not only the non-commercial side, but possibly even the commercial traders to step back in and start to buy. Okay, as I said, we went to a new low. And technical analysts by trade, what I see here was, initially there in June looked like the market was trying to establish at least some sort of bottom. We saw that huge move in mid to late June, where we jumped back up when we moved from like 322, the previous contract low, 322 back up to 360. Again, we saw some weather issues. We saw the non-commercial traders cover 150,000 contracts of their net short position. That's what sparked that 40-cent rally, that 38-cent rally. But what's happened since then is the weather, for the most part, has proven to be benign to beneficial. There's been no real weather threat outside of one area of Iowa for right now. And so what we've seen is continued pressure. The idea that the crop is getting larger and larger and larger. But think back, if we back up here, the selling has not been coming from the non-commercial side. So that means it must be coming from the commercial side. And that's what's interesting. That's really the more bearish aspect of this market. It's that if non-commercial traders aren't selling right now, and there's only two sides to the market, non-commercial and commercial, and if they haven't been selling, if they haven't been the ones actually pushing this market to a new contract low, then it must be coming from the commercial side. Because we just saw a new low this week. Technically, we're close to being oversold. Looks like we could still have, that's the stochastics with the red circle down lower. So it looks like there's still some room for this market to possibly move lower. Again, there's that next 310 level target sitting down below that I've gone ahead and drawn in. Now, if I pull up a long-term monthly chart on Dec Corn, and this just looks at Dec Corn contracts by itself, not just the 2020 contract, but this goes back and charts just the December contracts going back, in this case, through 2001. We can see over on the left-hand side that spike up, that spike through the red line that's cutting across. That's October 2000 and I believe 2006. That was the birth of the ethanol demand market in corn. That was when the RFS program kicked in, the 2005 Energy Policy Act kicked in, the fact that we weren't going to have the acres to meet the new demand, the changed rules that allowed more speculation in commodities in general, but it was designed to really draw more money into the corn market, which is what the effect was. And so we rallied beyond that 288 high, sub $3 up to almost $8 by 2008. Just an absolutely incredible move. And of course we fell down. What we're looking at right now, if we turn our attention back over the right-hand side, we're grinding lower. We're under the pressure of this trend line resistance. It just keeps pushing December corn lower. And what we're doing now is approaching the October, it's either September, October low of about 314 3/4. So we're almost there. We're almost to the point of breaking below that low. And if that happens, we could see December corn go all the way back to where it was when we first started the energy, when we saw the ethanol demand market begin. So, at some point, corn's going to have to change course. Yes, the monthly chart for December corn is showing a sharply oversold situation. That's usually bullish. But as a mentor of mine once said, one of the most brilliant minds I ever had a chance to visit with, as he pointed out, markets can stay overbought or oversold a lot longer than we could stay solvent. And Dec Corn is certainly acting like it may want to prove that point once again. So initially, we've got some support at the fall low of about 314 3/4, around 315. If that doesn't hold, then we go back to that 288 low, actually 288 high from the spring summer of 2000 and 2006. Excuse me. If I look at the cash corn, and this is looking at the monthly chart for the Commodity National Corn Price Index. This is another reason to have some hope. And one of the things I've been talking about on my website for quite some time is that I see a long-term uptrend actually trying to begin in the cash corn market. And to me, the Commodity National Corn Price Index is the intrinsic value. It's a weighted national average. It's the intrinsic value of corn. And again, we saw over the course of the spring and early summer, we saw a decent rally, but then all of a sudden, June came along and we saw this spike and saw it sell back off. And that actually established quite a bearish technical pattern on the monthly chart. And then July came and we saw continued pressure. So now what it looks like is that we might, over the course of August, see a test of the recent low down near 272, 273 by the NCPI. That price, that low is going to have to hold. It really needs to hold, or it's telling us that the cash market is set for a breakdown. Now all of a sudden, okay, so we've got the cash market that could break down if it can't hold its low, and we're facing what could be another near record, if not record, crop, according to some private estimates that have come out this week. So, you know, you're sitting here, if you're like me, you're sitting here wondering how in the world are we going to limit the sell-off in cash corn to 10 cents, and we haven't even started harvest yet. Seems rather daunting. Seems like it's going to be very difficult to do. Again, we have to find some buying somewhere. And I talked about how it wasn't really the non-commercial traders putting pressure on this market. This is a look at the commercial side. Oops, let me go back. This is a look at the commercial side of the market. This is how I read fundamentals. I really don't care about USDA reports. I don't care, as you know, those of you who followed me, no, I do not care about USDA reports. I'm interested in what the real fundamentals are, not the imaginary numbers, but the real numbers that the market is showing us. And we get a feel for that by looking at the spreads, by looking at the percent of full commercial carry the spreads are covering. And if we look at the CEP-DEES, that first column, first row, we've got a 12-cent carry in the spread, and that covers roughly 46% of calculated full commercial carry. If you look at the scale that I've developed over the decades, 33% or less is considered bullish. 34 to 66 is considered neutral, with 50% straight up neutral. And we are running close. As we look at this forward curve, when I pulled it at here at the end of last week, at the end of July, these spreads were almost to a T, running near 50%. If we look out at the September to July, taking most of the 2020-21 new crop marketing year into effect, 39-cent carry, 45% full commercial carry. So the entire length now of the 2020-21 marketing year is sitting in neutral. This is quite a change. Those of you who have been with us on all three webinars, or even if you were just with us on the last one, know this is a change from what we saw before, when most of the spreads were either bullish, they were 33% or less, or borderline bullish. They were, say, 36, 37%. So we've seen not only has the futures markets come down, we've seen the futures spreads with stronger carry, meaning we've had a great deal of commercial selling in the market. That's where the pressures come from. And so if the non-commercial traders are looking at the commercial side, looking at the real fundamentals of the market, and they see that there is an opportunity for them to push the market down again, that 320 that we talked about being the low end of the range going back to 2014 will not hold. And if it doesn't, again, we're looking at 310, we're looking at $3. We're looking at taking out the fall of 2016 lows and possibly going back again to the beginning of the ethanol demand market back in 2006. So, you know, it's a troubling time. August usually isn't bullish for corn, and it's certainly set up, unless something changes, unless something miraculous changes, is set up to be another bearish month here in 2020. So the outlook, seasonally, the market tends to trend down through late in the month. Technically, again, using the round number reliance, we're looking at, if we break through 320, we're looking at 310, possibly a test of $3. The August 16 low was 315. Dec Corn's already its lowest mark since 2014. And they're, even though non-commercials are net short, they could rebuild their position after recent covering. Fundamentally, the market's neutral, indicating the commercial side isn't convinced by the wildly bearish private and USDA estimates, but they're growing less bullish. I think that's an important distinction. They're not necessarily growing more bearish, they're growing less bullish than what they were just a month or so ago. All right, November soybeans. Again, August, September, pretty ugly month. Pretty ugly couple of months here. As we finish off summer, start off fall, you see that we actually post a low on the 5-year index. We actually post a low weekly close the first week of September. We've had a decent rally, but the market is also starting to break down. It looks like we're joining the 5-year seasonal index at this point. We've seen some contra seasonal moves over the, going back to last November. It's all, the argument could be made that we are possibly following the 10-year index. I could see that argument, and if that's the case, then we tend to post a low in, say, mid-August, bounce up into mid-September, and then fall off sharply into early October. So I think the jury is still out a bit on the November soybean contract, but there's some other aspects of it that make me a bit nervous and make me think like we could be tracking again closer to the 5-year index without not really paying that much attention to the 10-year right now. And one of the first ones is its price distribution, where we're sitting in about the lower 15% rather than the very low end of the range. We're sitting in the lower 15% with our latest close around 882. So that gives us some room to go down, another 40-50 cents to go down before we reach the low end of the range. And so, again, I just think there's some room in this market. Seasonally, soybeans look to be a bit bearish. We're running ahead of schedule progress-wise, so we're removing some of the potential weather scares, weather issues in the market. So again, there are some bearish factors lining up in new crop soybeans. And it's this busy chart. I understand that. Again, it's not quite as dramatic as what we've seen on Dec Corn, but to me, it looks like a top on and again, I like, based on the Goldilocks principle, I like to look at weekly charts as opposed to daily charts, which are too hot, and monthly charts, which are too cold. They tend to be too cold. So I look at the weekly charts, and this looks like a bearish breakdown to me. And it would fit in with the seasonal patterns that we tend to see. And so, again, the index, the price distribution range showed that, the bottom end is 830. That would basically mean that if we look at this chart, the November soybean contract should go back and test its contract low down around 831. Could that happen? Absolutely, because the weekly stochastics are still up closer to being overbought than they are oversold, meaning there is ample room to the downside for the market to fall. And this is why non-commercial traders have held a large net long position. They built it up to about 150,000 contracts until the last 3 to 4 weeks have seen them cut that a bit. They've cut it back down below 120,000 contracts, but there is a long way between that and par. There's a lot of contracts left to sell if they want to bring this back to par, if they feel like the fundamental side of the market or the commercial side of the market's growing more bearish. There is some room for them to continue to sell, push this market lower. Fundamentally, I'm more interested in below the green line. I'm never interested in the August and September contracts. They're very low volume, little trade in those. Makes basis analysis very difficult this time of year. But what I'm doing is I'm turning my attention already to the new crop market. And as we see the Nov Jan showing a carry of 6.25 cents, covering about 32% of full commercial carry. So again, that's bullish. And if we go out and if we look at the Nov July running the whole course of 2020-21, we're only at 23%. So that's bullish. It is. But it's been changing. Just as with the corn, we're seeing these carry numbers strengthen. We've removed, some of these used to be inverted. Some of these spreads used to be inverted, meaning an extremely bullish reading. Those have been erased. Now we're just looking at carry throughout the entirety of the forward curve. And it's growing, again, less bullish. We're moving some of the spreads actually out into neutral. Most of them still in the bullish range. They're just not as bullish as they were before. And as again, here's a look at the July Nov spread. We've seen a complete breakdown. We're actually down closer to the 23-cent mark. When I grabbed this, it was at 17.5 cents. It's moved down to 23 cents with the idea that this downtrend of the spread itself could reach as far as 34-cent carry back to its lifetime low. So again, I think the market's going to continue to get more bearish. If so, from a increased commercial selling, and that could be what drives us down towards the lower end of our price distribution range here over the end of summer. The outlook seasonally, the market tends to trend down through early September. Pressure could come from continued non-commercial short covering. That shouldn't be short covering, that should be long liquidation. I apologize for that, particularly if the market's forward curve continues to see stronger carry. Right now, private and USDA new crop estimates are very big. We saw that again this week. Early 2021 marketing year could see increased export demand. There's a lot of chatter about that. Everybody wants to get excited, hoop and holler and all this. We're selling all this to China. We're doing this and we're doing that. China's going to save us. They're not going to save us. They're our trade war enemy. I hate to break it to you. They're not going to save us. What happens? This is perfectly seasonal. Seasonally, we move 75% of our total exports in the first 6 months of a marketing year. So what's happening right now as we get ready to move into the beginning of the 2020-21 marketing year is just purely seasonal. So I know a lot of folks are going to continue to get excited about that. We need to take it with a grain of salt. We need to keep an eye on, what we need to remember how much we normally move over the first 6 months of a marketing year. So with that, that's got my side of it covered. I'm going to turn this over to Michael. And again, please send in your questions. There will be plenty of time at the end to answer your questions. So again, thank you for joining us. Michael, it's all yours.
Okay, thank you very much, Darin. Appreciate it. An excellent presentation. We do have several questions so far, so we'll address those here at the end. Keep them coming. We should have plenty of time for more. And in the meantime, I'll dive in here with some of the things around Commodity View and the new things that we're doing there. Or some of it will be review from the last time or two as well, just because some of the data is updated and some good stuff to review. So on my screen right now is the Commodity View platform, which is a browser-based market intel platform covering everything from global futures and options to North American and global cash prices to boatloads of fundamental supply and demand type of data. Again, globally on that as well. Right now we're looking at our yield forecasts. So in addition to gathering and aggregating and distributing some of the public supply and demand data, Barchart also creates our own proprietary yield forecast for corn and beans. And we're looking at that right now. The way this is organized is by state. And so here I'm on the tab for Iowa, and we have the total Iowa forecast of 202 bushels per acre. And then you can also look at that by region or crop reporting districts. So these are the 9 crop reporting districts in Iowa. And then you can even go so far as to look at county by county yield forecasts. And all the other states are available. I can also jump over to the US and see our total US forecast. It's currently at 176 bushels per acre for corn and just shy of 50 bushels per acre for soybeans. And I can also see that in charts below. So I'm going to pop back over here to Iowa. And you can see if I click on Iowa right now, we're looking at the Iowa forecast in blue. In red is the total US forecast. So you can see how a particular state compares to the national forecast. And then in orange is the nearby price for corn. And of course, you can do the same thing with any state and with soybeans as well. So those are a couple of ways to look at our yield forecasts. And the current updates up on top, the historical and current down below, and then geographically in the maps over on the right-hand side. So we saw a bit of this last time, but what I wasn't yet able to show you is how you can animate this. So you can see right now, we're looking at forecast back from the beginning of the season. If I click on the little arrow to animate that, I can see how that has updated and changed through the season. There you go. And you can even go back to prior years and animate that all the way, say, through 2019 and through year to date 2020, all in one process. Very similar on soybean yields. Same kind of organization. In this case, on the right-hand side, I'm looking geographically rather than at county level. I am looking at the crop reporting district level. And I can also jump that up to state level as well. I just come into the menu item here, go to yield forecasts and change that to states. We get the state level forecast or down to the county, however I want to look at that. And again, that can be animated to see a change as the season progresses. Okay, so that's our yield forecast. We actually had a question on this earlier, and so I'm happy to have been ready to show that to you. Some of the analysis that's available, some of the new things that we've done. We've made some progress in our seasonal charts. So rather than just doing a seasonal chart, say on Dec corn, you can now do it on expressions as well. So if I want to do a seasonal chart on, say, the nearby corn spread, that's what we have there. If I want to do a seasonal chart, say, on the September-March spread, do that as well. So I can either do relative first month, second month, first month, third month, or I can hard code the months and look just at Sep March or Dec March or Dec May, whatever I want to do there that makes sense. You can also get a little bit fancier and do, for example, a seasonal chart on the soybean crush spread. Like so. And then one that I like in particular is being able to do seasonal charts on the crop progress. So here, for example, we're looking at Iowa soybeans and setting pods and that stage. If I click on the corn silking, we can see the progress there as well. You can see the blue line is 2020, and we go back about 5 or 6 years, and the green line is the average for that over the 6 or 7 years that we have shown. And so you can see how how this year is progressing compared to last year. The purple line, well below trend, of course, was last year. Okay. This we saw last time, but I just want to reiterate because we did have some questions come in around the depth of our fundamental data. And there's a lot more, but here, for example, is our crop progress report. And again, you can see this is organized by each stage for both soybeans and corn and other commodities as well. We have, of course, the wheats and whatnot as well. This is just showing the corn and the beans. And you can see the overall U.S. progress as well for each of the stages, or go into a particular stage and see the progression for that stage across all of the states. And then again, here are the seasonal charts that can accompany that. And you can look at it historically as well. And go back over time, and you can also pull any of this data into Excel, and we'll see some of that here in just a few minutes as well. And then finally, we have the crop condition data. So again, the USDA reports that come in weekly. You can look at each rating. So this is excellent for all of the reported states, and good for all of the reported states, and so on. Or you can come in and see the overall rating for the U.S. and for each of the categories. So right now for corn, we've got 17% excellent, 55% good, 21% fair, 5% poor, and 2% very poor. And again, of course, all of that can be charted as well. Okay, very good. I'm going to switch over to Excel for just a few minutes and show you some of the things that we can do there now as well. One of the things that we have that's really unique is that we collect cash prices from 4,000 locations across the US and Canada. But we also take that data and add further value to it by calculating volume weighted average prices from the county level on up to the national level. So what I've done here is I've pulled in that the basis levels across all of those counties, as you can see here, and then just simply made my own map within Excel from that basis data. So again, every growing region, all of the counties within those growing regions have a calculated volume weighted basis for that county based on all the raw prices that we collect. You can also use that same data to create a seasonal basis chart. So here I've loaded in, using the Excel add-in, about 5 or 6 years of historical data for the basis. This happens to be Iowa that we're looking at right now. And I calculated, put those prices or those basis levels in monthly buckets, summed up the number of data points in each of those monthly buckets, and then calculated a seasonal average, which then you can use the charting tools in Excel to graph the seasonal average basis. If I want that to be, let's say, the US instead of Iowa, I can just change that to US. Go back over to time series and hit refresh. And now we're looking at the same data, but for the total US basis rather than just Iowa. So just by changing the last 2 digits, I can go from state to US. I can also, let's say we want to go back to Iowa and we want to look at Boone County. I'm just going to put in BO for Boone County. We're going to recalculate that. And there we have it. So very, very easy to really dive in and analyze all of that raw and index basis data within Excel. Taking the corn condition data that we saw earlier within Commodity View and pulling that into Excel, again using the Excel add-in. You can see here I just pulled in all of the states and all of the categories of the rating, and then put those into a table of excellent, good, fair, poor, and very poor for each of the states, and then created kind of the traditional stacked bar diagram of that. So you can see, Minnesota, for example, is about 85% good or excellent. Same with South Dakota, it's in that same range. Ohio, good and excellent are down around 50-55%. If you wanted, you could also pull in the historical crop condition data and look at this year over year as well, or look at this year's conditions versus a 5-year average or what have you. The other thing that I had done here, and it was kind of funny because I was talking to Darin beforehand, and he said, it'd be really nice to have a weighted index of the conditions state by state. Well, that's exactly what I did here. Again, I pulled in that data, assigned a weighting to each of the categories. So 100% for excellent, 75% for good, 50% for fair, 25% for poor, and 0 for very poor, and then calculated a weighted index of the condition. And then using the mapping tools in Excel, was able just to come up with a real quick pictorial of how the conditions are looking state by state. And there's other states available. I just picked 10 or 12 to work from here. Okay, and then lastly, a big enhancement that we've just made to the Excel add-in is on the time series data. You can now apply studies to that time series data. So you can again, right in Excel, and apply a moving average, a stochastic, Bollinger's, up to there's 60 or 70 different studies currently available within the Excel add-in to add to that historical data. So here we're looking at Dec Corn, open, high, low, close, going back, I think about 500 bars, 200, 300 bars in this case, and then applied moving average to those. And so all of that historical data then is calculated, and you could build your own signals right here within Excel if that was something that you wanted to do. Okay, with that, let's take a look at some of the questions that we have received here while we were talking. Darin, one for you here. I think you somewhat answered it, but maybe there's a little different perspective here. It says the dollar index keeps going lower. How come corn prices are so low and wheat and beans breaking? I guess you kind of covered the pressure on beans for sure. Wheat maybe fall in that same category, but maybe more generally, what kind of correlation do you see between the dollar index and at what point does the sinking dollar give us a big enough advantage that we're a very favorable choice for exporting?
It's a great question, and I appreciate it coming in. There's long been talk of the correlation, the inverse correlation between the dollar and U.S. commodities, and it is true that as the dollar goes down, U.S. commodities get more attractive. And again, let's think back to the incredible sales that we saw, and I want to emphasize the word sales, not shipments, the sales that we saw during July of both corn and soybeans and some wheat. We've also seen the Chicago wheat market go considerably higher over the last number of months. And the Chicago wheat market is actually the one that has the best inverse correlation with the dollar. And when we talk about the dollar weakness, what we're really talking about is the dollar weakness in relation to the euro, because the euro has skyrocketed against many other currencies. We haven't seen that much change. And in fact, as we look at the Brazilian real, if we want to bring into the discussion, the soybeans, the Brazilian real is actually still quite low as well. Now, I have seen some studies where U.S. port prices for soybeans are below port prices for Brazil right now. But let's think about the time of year. It's winter time in Brazil. It's 6 months, away from us. So that puts them in early February. And basically, they've shipped so many soybeans that they don't have anymore. So their available supplies are tight. So you were going to see some more sales of U.S. soybeans being made. The lower dollar really doesn't. It comes into play if we look at the overall value between U.S. soybeans at port and Brazilian soybeans at port. So that's why we're seeing some more sales right now. Why haven't the markets really moved off of the lower dollar? We have too much supply. And we haven't seen that much demand. We saw some great sales in July, but now we have to actually ship those sales. That's the question. That's what we're going to do. That's where we're going to see basis come back into play. That's where we're going to see so many other things come back into play. And as I look at the daily, weekly, and possibly even the monthly charts of the dollar, if I threw the name off of it and I take my mind and I erase the possibility of what the fundamentals are in the dollar right now, it would suggest that we could see a trend change in the dollar and in the euro, meaning the dollar could start to go up. I can't put a fundamental reason as to why it should. We're still creating way too many dollars, pouring it into the system, and no one's interested in buying the dollar right now. But technically, it looks like we could make the argument that the dollar's getting ready to go up. And if that happens, then what happens to all of these export sales that we saw in July? Does it all of a sudden just dry up? So certainly something we need to watch. Why didn't the grains move? Why didn't corn and soybeans move when the dollar came down? Soybeans did a bit, but the underlying reason is just too much supply at this point.
Okay, excellent. While you were talking there, Darin, I brought up
I appreciate that, Michael. That was perfect. That was perfect.
Soybean prices against the dollar index. All right, excellent. Another question here. what price would you lock in feed corn?
That's a great question. I wouldn't be in a big hurry right now to lock in feed corn. Right now, I'd probably still be going hand to mouth, buying it on an as needed basis. Because again, if we are going to have, and I know the bar chart, the commodity view average yield wasn't as large, so production isn't going to be as large as what some of the private estimates that have come out. But regardless, we're looking at a lot of corn coming we're looking at a lot of corn coming into the system here over the next 30 to 60 days. I think that's going to push basis down. I think the cash market's going to come down. Again, we're only 10 cents away from breaking support in the commodity national corn price index. So I would go hand to mouth right now until I saw some reason to load up longer term. Go hand to mouth. Let's see if the market breaks down. Let's see if basis gets weaker. Then who knows? We go to new lows. All bets are off. Again, Dec corn could go 320, 310, maybe 3. Down below that's getting closer to 290. At that point, maybe we'll look at where the cash market is, where the commodity national corn price index is. Maybe get some long-term cash locked in at that point.
All right, excellent. Darin, we also have more of a comment from a viewer that was on last time, and maybe you want to just add some perspective. It says, "Thanks for your answer last time. Would have gotten destroyed buying corn, selling beans after last month's number." We had the question last month, would you trade that spread?
Well, I appreciate that. I do, and I truly appreciate you joining, everyone joining, all these different times. And again, it comes down to, we can look at, the individual pieces and parts, as Michael pointed out. You can pull up all these different spreads. I like to look at spreads. I like to look at all the different things that are possible. And if the different moving parts, if the fundamentals don't quite fit, sometimes we have to take a second look at it. So I really appreciate your comment, and I thank you again for joining us today.
Okay, excellent. Several more questions here. We have a few minutes left, but a lot of good questions today. This one probably more directed at me. It says, "Hello, in addition to technical analysis, do you offer fundamental research, i.e. supply, demand, ending stocks, etc.?" We certainly do. Showed just a small fraction of that earlier with the yield forecast and the crop conditioning, crop progress, and those things. But there are also all the other parameters there. All the WASDE data is elementized, and so is available in reports and in quotes and charts and things like that. On-farm, off-farm storage, export sales, all of that is available. And again, not just from the USDA, but we also have global reporting agencies such as StatCan and Eurostats for Canada and all of Europe. So very, very global perspective on that supply and demand data as well, and across more commodities than we've talked about today too.
Michael, I'd like to add something to that as well. From my perspective, on our website as well, most of what I do, I'm not going to say that. We provide fundamental analysis, but not like what you're going to get everywhere else. It's my take on fundamental analysis. It's what I think is important, and what I think is silly, I usually leave out, which is majority of what fundamental analysis is. But I do look at fundamental analysis. We look every week at, say, export sales and shipments. We look at the WASDE reports when they come out. I talk about the few things that are relevant there. So we do track it as well. So we have a mixture of technical and fundamental analysis as well.
Fantastic. Okay, here's a kind of a series of questions, Darin, about the weather. And he said it's always about the weather. So here they are. I'll just read them all off, and then you can kind of address, as you see best. Question is, are there past records of production problems relating to excess of rain in the Midwest? Are we currently seeing average rains or above normal? Can we see a price rally because of too much rain?
I'm going to answer the last one first, and all we got to do is think back to 2019. when we had too much rain. We had flooding everywhere. We had I remember Michael and the group and my friends from Barchart came down and we went on a road tour across the Midwest. And as part of that, we drove from Omaha down to Kansas City. And as Michael pointed out in the car, it was like we were driving across an enormous lake. You know, most of the Midwest last year saw too much rain. It was too wet. It was flooded everywhere. Did the prices move? No, prices went down. So we can measure, we can measure rainfall. We can measure rainfall as percent of average. We can look at, we can look at dry. We can look, we can look at all of these different things, all of these different fundamental factors. But what I would suggest, and it's what I talk about on our site all the time, is, are they important? Is it important? Because what really matters? What really matters is what the market thinks. And what the market thinks right now is, again, as we go back to those future spreads, and we look at the fact that they've gone from bullish to neutral and are looking at growing, and seeing their carry strengthen even more, is that whatever the rainfall is, whatever the production is, whatever the overall supply and demand number is, the market is growing less bullish. And that's the key. Can we rally the market on too much rain? Last year, we could not. Will we someday? Sure. But if we couldn't do it in 2019, I have no idea what it's going to take as far as too much rain, too much flooding to get the market to move higher.
Okay. A follow-on to that question was, I'm a producer. How can I hedge against possible significant black swans? Should I buy puts?
I always love it when black swans are brought up, and usually it's my good friend from up north that brings these up to me. But the best way, and black swan ties into chaos theory for those of you not familiar with the term, and we can protect ourselves from chaos theory by using some filters. Number one, we can look at seasonality. Number two, we can look at price distribution, like what I do. And yes, the best way to protect against a potential black swan is through the use of options, but we want to do it at the right time. So we want to do it, that's where we have to track volatility, because just going out on a limb and saying, I'm going to short sell here, going to buy here and that, it can be kind of risky. So to protect against the unknown, sometimes options are our best play. We just have to figure out which option strategies are the best, because it's not one size fits all. We have to take into account seasonality, probability, price distribution, volatility, all these things. And by doing that, we can protect from some of these. And we know there are so many unknown events right now, and we've seen it play out over the last number of years, how one comment, one headline can change everything. And so to protect against that, sometimes our best bet is some sort of option or option-like strategy.
Okay. Good for a couple more, Darin?
Absolutely.
All right. It says, on soybean export premiums, do you think that these premiums will go down like the 10-year chart showing prices at 830 as lows? Appreciate your thoughts.
Okay, as far as export premiums, I'm not sure of what that is, but if we're looking at, so I don't want to put words into assume something that's not there. So if I just look at the cash value, the Commodity National Corn Price Index, do I think it could go down to 830 like what we talked about? I think there's a good chance that it could. A lot of it's going to come from continued commercial selling, and if that triggers the non-commercial side, then we've got both sides selling, and this thing could snowball. What's going to depend, what's going to help possibly on the export side will be as we move into the new marketing year, as we have more supplies available, basis is going to take a beating. That's going to help push cash markets down, and it's going to make it overall make it more attractive on the global stage. And if we are already priced below Brazil's port price, and they are running tighter. This is our window of opportunity to make some sales. So yes, I think the cash market's going to come down. Yes, I think basis is going to soften or weaken, excuse me. And I do think that's going to lead to some better export numbers here over the first half of the 2020-21 marketing year, which is seasonal. It's not extraordinary, it's just seasonal.
Okay, last question, then we will wrap up. Do you foresee wheat Chicago futures to return from the inverse versus KC and Minneapolis?
I don't see it happening anytime soon. Again, the dollar is weak, euro is strong. We did see the soft red winter wheat. We saw a smaller production in 2019. 2020 has been average so far. So I think we have tightened up the soft red winter, possibly. I think there's just a good argument out there right now for soft red winter to stay stronger than hard winter. We've got too much hard red winter on hand. The outlier could be hard red spring, but supposedly Canada is going to have a record crop, is what I've heard from some customers. So we could see spring wheat under pressure as well. I think the strength of the wheat complex is going to continue to be, at least for the foreseeable future, the Chicago soft red winter market.
Okay, thanks very much, Darin. And thank you all for joining us today. Really appreciate it. A lot of good questions, good participation. This does end our summer series, but we will continue to have webinars going forward on a periodic basis to update you on the markets again and some of the things that we're doing in Commodity View. If you liked what you saw in Commodity View, if you're a current subscriber and would like some help setting up some of the displays that we showed, just contact myself, Browne at barchart.com, or your sales rep, and we'll get you set up on that. If you're not a Commodity View subscriber and would like to take a look at some of the things that you saw today, same thing. Just contact us, reach out, and we will get you set up and going on a free trial. Again, thank you all very much and have a fantastic afternoon.